first question, so we're supposed to focus on millennials. There's a lot of hype around this age group, this demographic. Obviously, they don't have that much money right now, but they're going to in the future. How do you kind of separate between what's hype and what's reality in this space in your guys' businesses? I don't know who wants to take it first. Maybe Josh?
Hi, everyone. It's mostly hype for now, but we'll figure it out eventually. I don't think anyone really knows what millennials will act like when they own real estate, which I promise you they will, when they have children, when they're saving for things like someone else's college retirement instead of their vacations. And that stuff will all happen. And I think what a lot of people tend to do is they get confused between age differences and generation differences, right? So there are some things that are unique and endemic to millennials as a generation, but then there are other things that are just about age, and everyone grows up ultimately. And I think separating those two things out will probably be a worthwhile endeavor. And the best way to do that is to read a lot of history. And when you do that, you realize every generation thought they were really different and really special. And then some of what made them different and special stayed. And then a lot of it faded away and they just became regular middle-aged people like what I'm becoming now, which is not very special.
I told you guys this one was going to be fun.
So I don't think that's controversial, by the way, what I just said. So.
I mean,
John, go ahead.
I guess our view is that they, the way they engage with financial products or organizations is different than it's been historically. And I think the reason that John and Betterment have been successful is because simplifying access to those products is what the expectation is. I think, so we think of it all just from the consumer experience. So, the expectation is that they can access anything about the experience that we created, both online, but more and more often on mobile devices. So I think that, and I also think that there's an expectation of sort of bundling of products where it makes sense. So an example of that would be if I'm taking out a student loan or getting a mortgage, there's a natural intersection where I should be able to access insurance to sort of align against that at the same time. And I think what John was talking about before when he was up here by himself around just the simplification of it should be easy for me. Somebody should be able to allocate assets between checking and savings and investments, and it should be streamlined and seamless for me so that I don't have to worry about it. And I just think that expectation of ongoing service is something that the millennials, I think, expect more than the people who have traditionally been going to the bank or to a broker to deal with directly.
Yeah, I agree with both the panelists here, and I think there's a sense that millennials are different, and in a lot of the ways that we talk about them being different, we're just really talking about technology change. Everyone wants the best technology, and we hear this from retirees all the time who say, I don't understand why everyone says this is like a millennial product because I obviously want this as well. It's kind of like your iPhone, sure, maybe, adoption was a little bit greater for like touchscreen phones for millennials early on, but now, my grandmother has one and I feel like everyone has one. Ultimately, we're just talking about technology change.
Okay. We talked a little bit earlier about the risk to incumbents. Josh, your firm, I believe, started some sort of robo-advisor inside of it. Why did you guys do something like that?
We viscerally dislike the incumbents in our industry. I can't say how much people like John and Betterment have been inspirational to us because they're reinventing what's possible, and we're a firm that very much wants to take advantage of the things they're coming up with. We may not do things exactly the way they do. We're certainly not getting into a marketing war or an arms race. We're learning from what they're finding success with, and we're seeing which bits and pieces and aspects of that we can incorporate into our practice. And I'm already almost 20 years in the industry, so I've seen several cycles of this. Where something that only a handful of firms had a lot of money, capital, they had these barriers to entry around them built on whose grandfather started the company, et cetera. And then companies come along and say, oh yeah, well look what we can do for our customers, and look what we can do with trading speed and performance reporting and on and on and on. And so I've watched this play out several times. it's not that the incumbents always lose, it's that the incumbents are always forced to adapt, sometimes willingly, sometimes for survival. But in the end, the companies that come along with better solutions, they do win. I know it's not like that in every industry, but in finance, absolutely they win. The incumbents can also win, but they have to be willing to do things differently. So, I guess we look at ourselves as people that are trying to be opportunistic, people that are trying to stay with what's going on, but not losing sight of the fact that we're running a business. We're not running an incubator or an idea lab. So we have to be really realistic about what we can do, and how it aligns with what it is that we do for clients.
Okay, so is the way they be successful then, like LearnVest getting acquired by Northwestern Mutual? Northwestern Mutual obviously saw an opportunity in this space, or UBS partnering with SigFig. I believe Eaton Vance was also on that deal. Is that how the incumbents end up staying in the game?
Yeah, well, sure. There's acquisitions, there's partnerships that don't go so well, and then the incumbent says, you know what, it was nice being a partner with you. We figured out what you do. We'll just do it ourselves. There's a million permutations. I think the way to really lose is to take an extreme negative stance toward a development in the marketplace and then stick to your guns until you're dead. I think that's a surefire way to lose. And we're seeing that with a lot of mutual fund families now. They decided 15 years ago that ETFs were not good, and now they're acquiring fifth-tier ETF companies, and it's way, way too late to get market share. And I can give you 20 other examples. So I think the right attitude to have is, okay, we're an incumbent. There are negatives. We're perceived as old and stodgy, and we have bureaucracy. But then there are positives. If there's technology that we want, we have the wherewithal to bring it in, figure out how to integrate it, or if it's a partnership, we can get to the table with smart people like John. So I think that's kind of a dual way to look at it. Being an incumbent, it is what it is. You can't change what's gone on in the past. You can only change how you'll behave given present realities.
Okay. John Gardner, you want to add into that?
Yeah, I mean, I think and John probably had the same experience. When we were building LearnVest, we were approached by just about every big financial services institution, because I think they looked at, we had created a brand from scratch that had people, fell in love with what we were doing. We were transparent in the fees that we were charging and the service that we were delivering. And they wanted to find ways to be aligned with us, because I think that they saw that we were able to innovate without all the legacy issues that they had. And I think in Northwestern Mutual, the appeal to us was that they have 4.5 million clients. They've got an entrenched base of about 7,500 advisors. They do about $27 billion of revenue a year, and yet they have one of the best franchises in the world, but they're not organizationally set up to innovate very effectively. And what was appealing as we thought about working alongside of them was what we brought to bear was sort of how to think about challenging common assumptions, working on the technology platform that wasn't aligned to the way all the legacy systems that they've had for 50 years. So there was a natural alignment there, and I think it only worked because we were willing to sort of go in whole hog, because where we tried to have partnerships with incumbent institutions, it just never worked, because they were trying to learn from us and then send us on our way, or they weren't going to fully commit to sort of aligning themselves with us as part of the partnership.
Do you want to add anything?
We've all seen some of the same things. I used to work for the big banks before I started Betterment, and there were a lot of smart people there and a lot of really well-intentioned people. Institutionally, I found it was difficult to get them to launch really great new products. I mean, I would work on, among other things, product development was one of the things that I consulted them about. And we would go on a 6-month engagement building out a new auto lending product or deposit product or mortgage product and never talk to a customer in that process. And I didn't know anything about product development, but I just thought that was a little crazy. And I knew that we weren't really innovating in that environment. And ultimately, I would have to leave that and start a company, which was not something. I graduated from college in 2001, and tech was like this, and nobody was starting companies. I just never thought I would be starting a company, but I found that I couldn't innovate within the existing institutions, and I think both of these guys are, very forward thinking and have kind of the same attitude. I know, Josh has been talking about this for like a decade, and has been putting his money where his mouth is, and investing in tech first companies and so on. And John and Alexa got started before we did. You guys launched at TechCrunch
2009,
2009, the year before we did.
I think like there's good reason why it's so hard for the incumbent firms to innovate, right? Because whatever you build, you're probably killing an earlier version of something, and you've got these fiefdoms in banks especially that people are protective over, and so it's never just let's create. It's always let's create, and somebody's baby is either going to be radically changed or their usefulness at the firm isn't going to be what it used to be, so their job is endangered. That's never going to change. So it's much, much easier for smaller firms, frankly, like mine. We started in 2013. There's nothing for us to kill. So if we add something new, it's not in place of somebody's baby. But I don't think that's specific to fintech. I think that's a phenomenon no matter what industry we're talking about.
Okay, what about the partnerships where it's like they're not acquiring the firm, like Northwestern Mutual acquired LearnVest? What about a partnership with, like you guys did with Fidelity, UBS is doing with SigFig? How does that help those incumbents then?
It's interesting. We manage a few $100 million in assets for high net worth households, and we custodian with TD Ameritrade Institutional. And TD Ameritrade, in my view, has taken a very enlightened view on all of the fintech applications that want to do business with the advisors who custody on their platform. And there are like 10,000 of us, firms. So about 300,000 professionals in my industry. So what TD Ameritrade Institutional has said is, maybe it's a robo, maybe it's rebalancing software, maybe it's some kind of account aggregation software. Whatever it is, we're Switzerland. We're not partnering with anyone, but we will allow anyone that's got a product that meets our specs and our compliance metrics, et cetera, we will allow them to come in and work with the advisors on our platform that want to work with them. So what they're not doing is extracting a pound of flesh from startups, and they're not gating themselves off, and they're not picking a partner. So as a result of that, my firm may decide that we like Yodlee, which is account aggregation software owned by Envestnet now. Another firm down the street from us, also custodying a TD, might say, well, we don't like Yodlee. We had a bad experience, or the UI sucks, or whatever. And they say, we want to use by all accounts. From TD's perspective, whichever service allows the RIA to do business the way they want to do it, then that piece of software can be incorporated. Not every custodian has been this forward thinking. So we're lucky that we chose them without really even knowing this. And we look at what some of the other big incumbent brokerage and advisor platforms in the industry are doing, and they're going in the opposite direction. Everything's proprietary. They're building their own stuff themselves with Scotch tape and glue, et cetera, et cetera. So there's a very big difference in attitudes, and I think these guys have probably found that as well.
I heard from one of the companies that's I won't name them, but one of the companies that we've talked about today, doing bank integrations and doing multiple of those, and talking about it as the Vietnam of bank integration. Not my words, but I think I can sympathize, having been in that environment and knowing how difficult it is, and all of the compliance that you have to go through, and extra scrutiny then, and getting your product built into the bank's framework, in some ways kills it, right? It just kind of takes all the joy out of the work of building it, and it can kill the user experience for a whole host of reasons. And maybe it kills the product. I think one of the challenges that we see the incumbents having is they're mostly based on a transactional business model. Whether they're I'm not talking here about just charging for trades. I'm talking about we're selling you a deposit account, or we're selling you a mortgage, or banks are entirely transactional businesses. And they would like to be advice businesses. They would like to be in the business like financial advisors are, of recommending the best product for you, but they manufacture all their own products. So it's impossible for them to really be aligned with you and do things in your best interest because they have to sell their own products. That's how their entire sales force is compensated. That's how all of their management information systems work. They can't change that as much as they would like to. And we see in the future a lot more business going to advisors and advised models and taking it away from banks and transactional models.
Yeah. Anything to add, John?
I mean, I think just as it relates to the Northwestern Mutual acquisition, I think what we've found is historically, the heritage of the business was an insurance, a risk-based business, and I think that over the past 15 to 20 years, they've tried to become much more of a holistic planning business. And what we found is that of the 7,500 advisors they have, the ones that actually focus on upfront spending the time to get to know the customer and understand their more broad-based needs, as opposed to just trying to fit the insurance or risk-based product need in, are the ones that have much more robust and ultimately more economically fruitful relationships with the advisor. So I don't think it's necessarily misaligned, and the whole thesis behind the acquisition of us was our whole business was predicated on understanding the customer, consolidating data so we had a holistic view, understanding the customer, and then ultimately getting them to make a host of both financial and then more structural decisions. So that could be things like helping them set up wills and trusts and things like that. So I think that it's perfectly aligned. I agree with John, getting out of the transaction business, getting much more into the advice business, and being genuine about that, authentic about that, ultimately results in you being able to create much more financial product relationships than you otherwise would.
Yeah, you guys still haven't disagreed on anything, so I'm hoping I get something with one of these questions. Shifting gears a little bit, LearnVest started out dealing mostly with women in financial advice. Why did you guys shift away from that?
Yeah, I mean, I think our core thesis was always that there was sort of a huge gap in financial literacy in America. And when Alexa, who's my cousin, initially conceived the idea, she realized that there just was nothing that spoke specifically to her. So I would say that though we targeted women, it was actually creating more of an approachable, almost lifestyle-oriented brand around financial literacy and wellness. And we always had this ambition that we were going to build an advisory services business, but we had no brand identity, so we had to build the brand identity largely based on content and then layer into the advice business. And what we found was, though we were targeted towards women as we layered into the advice business, almost immediately, well, two things happened. We had lots and lots of couples that came to us. So now we're dealing with issues that weren't just dealing with women. And then about 40% of the single people that came to us were men almost immediately. So there was a natural evolution of our brand. And again, I think though it was targeted at women, it was much more around sort of, we wanted to create content that was accessible. And I think that everything that we've tried to do is sort of to demystify the financial decisions that you need to make.
Okay. Josh, is there anything you guys have to do in terms of, do women want different types of things in their investing? Do you gauge that a little bit when you deal with customers?
We don't treat them any differently. That's been something that we decided from the beginning. And I've got people in my firm that have all these licenses, same-sex couples, and they got all these designations, not licenses, but they went through these courses. And what we all kind of came to the conclusion was that people are people, and it doesn't matter if they're men, women, old, young. They're all going to have different quirks and different things that make them tick. So we decided very early on that our messaging would be sensitive to the fact that not everyone is a 50-year-old white male, which is what I think the brokerage business that preceded the RIA business was built on. I mean, let's put all our cards on the table. All the magazines written about finance were geared toward that customer. Even the giveaways, these golf trips to Myrtle Beach, it was all about 50 and 60-year-old white males. And we decided when we launched the firm that we were going to go the other way, that we were going to gear what we do toward individual people, not demographics, not sexes, races, marital status, etc. Not that there's anything wrong with having a niche. It's just not what we are. But I think it's great that companies have come along before we did and make this have this consideration be part of their content, part of their process, that there's another customer besides the aging white male, and they deserve to have information presented to them in a way that's sensitive to that fact. So I think we've come a long way as an industry. It wasn't without some prodding and poking, but it's happening.
I want to know, where are the women investors? we started out the same thesis that Josh did of, this is great for everybody. And we did focus groups before we launched. And women responded really strongly to the idea of Betterment and this automation and just we're going to manage it for you, stronger than men. And based on that, we thought, without designing it for women, that we were going to have more women than men customers. To the contrary, maybe 30% of our customers are women. And most of those women are younger than our male customers. Once people get married, most of the accounts are in the man's name, and that persists until there's a death or a divorce, and then you see women appearing as account holders again in older years. That is not the way. The
accounts are in the man's name, but is the man the person that's really in control of it?
Right. Fair question.
I don't run my own finances. Thank God, by the way.
For whatever reason, that's just what we see. And I've talked to there's a couple of new there's always have been advisors who specialize in divorcees or young women's practices, or there's even now robo-advisors that specialize for women. And when I talk to them about what's different and what could we be doing better, it is the difference that they see is one of confidence, and it's about just comfort with money. It's something I would love to understand better, but we're trying to fix it.
All right, questions? We have about 9 minutes left, so.
Is there a particular trend in millennials that you think is blown out of proportion, or you've seen differently in your actual day-to-day?
I don't know who wants to take that one first. Josh, you had quite a bit to say about that earlier.
I'll tell you the ones that are true. The selfie thing is totally real. It's like unstoppable. No, I think there's a lot of conflating the idea that just people are younger. So you hear all the time they're trying to figure out where did all the oil and gas savings go. So the price of oil went from 110 to 26, and oil at the pump was down 55-60% fast, and it stayed there for a while. And the economists kept saying, well, when is it going to show up in the economy? When is it going to show up? Because the retailers were missing earnings. Some of the restaurants were doing well, some not. They couldn't find it. And then this meme got started. Well, it's the millennials. They won't buy things. They only want experiences. And it's like, dude, when you were in your 20s, you wanted experiences. That's not generational. You wanted to be on spring break when you were in your 20s. You wanted to be out, at nightclubs and traveling when you were young. It's not a millennial thing. It's just we've got 73 million millennials. There are more millennials alive than boomers. Obviously, that math continues to go that way each day. They will eventually start acting like their parents' generation, but to just say they only want experiences, it's not true. They're gonna have babies. They're gonna want a lot more than travel and taking selfies in
Going to
in
Taylor
burrito
Swift
stores.
concerts.
I think that's way overblown.
Okay, anything to add, you guys? Any trends you see that are completely blown out of proportion? I don't think going to Taylor Swift concerts are completely blown out of proportion, but
I like T Swift.
I think the day I met you was the day Shake It Off came out, actually.
I'll never forget.
Never forget that. It's a special day.
Questions?
Yeah, we have two quick questions. The first is for LearnVest. What was the most interesting you discovered as you became a part of a larger institution, and have you seen the brand or service change because of it?
The brand or the what? Or the service change? Well, I think one of the best things that came about this was as a startup, we had to be focused every day on making very, very active decisions, and because you were either trying to quickly grow the business so that you could raise more money. And I think when we got acquired by Northwestern Mutual, they've been around for 158 years. They're a mutual insurance company, so they're not sort of betrothed into quarterly earnings. So the time frame by which we were able to sort of sit and think about the service that we ultimately wanted to deliver to the end consumer that aligned with the vision that Alexei originally had got way, way expanded. So it actually enabled us to sit down and be much more thoughtful about what was meaningful from a consumer experience standpoint. And we now have the time and, quite candidly, the capital to make that investment to deliver on it. So I think that was one big thing. I think what was also surprising to us was, getting acquired by a 158-year-old insurance company from Milwaukee, and we had a 105-person company in New York City. You would think that there was a pretty big misalignment from a cultural standpoint. And I think that we found that the underlying values of what we wanted to do for the customer were completely consistent. The way that we thought about getting there was vastly different, but I think we've been really surprised in a very positive way that they've tried to align themselves much more to the culture that we have, and recognizing that historically, I think the Northwestern Mutual folks thought about the rep as their end consumer as opposed to the ultimate customer, and then the rep's relationship was with the guy that was actually the person that was buying the insurance. And I think our philosophy has always been directly with the consumer. So I think we've reoriented the way that they think about the business in a very positive and constructive way as we build out some of the work that we're doing with them.
Okay.
Great. Last question before we have to wrap up. Earlier today, there was a comment that the success of things like robo-advisors and other younger generation products can be attributed much more to brand than technology. Do you agree with this? And if so, what characteristics of that brand are important?
I'll let John Stein take that one.
Yeah, I mean, is Snapchat built on its brand? I don't think so. I think it's just a different experience. And it's better in some ways than Instagram, Technology's changing. It's changing and if you want to talk specifically about robo-advisors, what we're doing is so much better than what Schwab can do for you or what TD can do for you. It's so much better to the core. The way that we trade for you is better than the way that they trade. We don't sell your order flow. They do. We just on a technical level, everything that we've built is superior, and it's built for the future. It's not built about the way that people traded 30 years ago. It's built on the latest technology. It's built for portfolio trading and managing taxes across multiple different account types, things that didn't exist 30 years ago, so no one thought about it, and so those legacy systems can't really support it.
Yeah, I disagree with that a little bit, because I think everything you said is absolutely true. You've built a better product, but I think that the consumer is not nearly as sophisticated or as educated as any of your staff is. So I think that the decision they're making between Betterment and Wealthfront or Personal Capital, which I know isn't a perfect comparison, I think is largely driven by the fact that either you've done a more effective job from a marketing standpoint, which I think you have, or you've done a better job at creating a consumer experience that, though all of those things around tax management efficiency exist, I don't think the consumer that you have actually understands what's happening by and large. So I think the challenge that I think we all had as small consumer finance companies growing up is to how do you get through the clutter, and certainly somebody like Vanguard or Schwab cannot spend you by 100 times if they want on a marketing standpoint.
You guys, we finally got some disagreement
Nice.
here too.
Mm-hmm.
I think we can end on that note, unless
I
there's
agree with
anything
both
else
of them, by the way.
All right, thank you guys.
Thanks.
Thank you.